BigBear AI stock is currently trading live at $5.08, down 4.78% in intraday trading on the New York Stock Exchange, as the broader tech sector experiences some mild profit-taking. This downward intraday action comes immediately after the company put up its most impressive weekly surge in over 8 months, morning high of $5.21, with heavy volume flooding individual brokerage accounts across Wall Street. While a sudden intraday drop might look like a simple setback on your standard trading application, the underlying market structure reveals a massive tug-of-war between retail momentum and institutional positioning. Today's price action shows that the stock is testing critical resistance levels, and while the surface narrative blames a simple market pullback, the real tension lies in how the market values unbooked contract pipelines against immediate realized quarterly revenue. The common expectation among retail investors is that any company with AI in its name should behave like Nvidia stock, exploding upward on pure hype and massive public sector spending. People look at the federal government pumping capital into national security technology and assume smaller defense software contractors will instantly replicate the massive, highly profitable scale of major enterprise giants. The reality is far more complex and highly fragmented. BigBear AI recently reported its first quarter financial metrics, showing a slight year-over-year revenue decline of 1%, bringing in $34.44 million compared to Wall Street projections. However, the absolute reality that completely blindsided short sellers and surprised the broader market was a massive 14% sequential surge in their contracted backlog, which expanded rapidly to $281.9 million. This backlog growth was heavily anchored by a single-source highly classified federal defense award valued at $53 million. This creates a fascinating divergence where the company's current cash inflows look stagnant, but their long-term institutional pipeline is quietly solidifying behind closed doors. To understand why this gap between immediate revenue and long-term backlog matters so much right now, you have to look at the trading volume and technical setups across major institutional platforms. When retail money uses standard tools like the Robinhood app or looks for general investment help online, the focus tends to be on short-term daily swings and social media sentiment. Over on platforms like StockTwits, sentiment on BigBear AI abruptly shifted from neutral to extremely bullish following a major international commercial expansion announcement out of Central America. The company secured a commercial agreement with PTG, the largest logistics and shipping operator in Panama, to deploy its proprietary cargo chain of custody tracking software. This platform uses advanced analytics and biometrics to verify shipping identities and actively flag global smuggling risks along major trade routes. For a business that has historically been viewed as a slow-moving government contractor, breaking directly into commercial international logistics is a massive structural shift that completely changes the risk-reward profile for active investors. This international deployment is a major fundamental catalyst because it directly addresses the biggest criticism institutional investors have held against the stock, which is extreme customer concentration risk. If you use sophisticated analytic screeners on an individual brokerage platform or execute advanced trades via the Interactive Brokers platform, you can see that a massive percentage of the company's historical revenue has been derived from a tiny handful of United States defense and intelligence agencies. If a single federal program faces a budget cut or a contract gets delayed in Congress, the company's quarterly numbers take a severe hit. By moving into international logistics hubs like Panama, the company is attempting to prove that its software is highly repeatable and scalable outside of highly classified military ecosystems. This commercial push is being actively steered by heavy-hitting leadership additions, including a former acting commissioner of U.S. Customs and Border Protection, who joined the company in March to leverage deep structural relationships within global trade and customs administration. When analyzing the technical data on advanced investing sites, the stock's recent price action is hitting a clear psychological ceiling right around the $5.40 mark. Chart watchers and professional traders utilizing the Interactive Brokers trading platform note that this exact level has historically acted as a major point of overhead supply, where previous buyers look to break even and short sellers aggressively add to their positions. The fact that the stock surged over 20% last week to challenge this line shows immense buying pressure, but today's minor retreat to $5.08 demonstrates that the market is demanding clear, sustained operational execution before allowing a clean breakout toward annual highs. Volatility is further amplified by the company's high beta coefficient of 3.06, meaning the stock regularly moves 3 times faster than the broader S&P 500 index, making it a favorite for aggressive daily traders who utilize Robinhood stock trading and online investing apps for rapid short-term capital allocation. Let's step back for a moment and look at the broader landscape of modern self-investing and asset management. Investors searching for automated diversification through platforms like Schwab Intelligent Portfolios or a standard SoFi robo-advisor often miss microcap companies like this because automated systems prioritize massive liquidity and consistent profitability. If you manage an individual brokerage account or build a long-term portfolio using Fidelity Investments, you have likely noticed a massive performance gap between giant tech stocks and speculative small-cap software plays.
While giant companies can self-fund massive research budgets through free cash flow, smaller companies must maintain pristine balance sheets to survive macro tightening cycles. A deep dive into the company's reported balance sheet reveals a debt-to-equity ratio of 0, accompanied by a current ratio of roughly 1.8. This specific financial cushion is incredibly rare for a small-cap technology company that is still working to establish consistent net income, giving management substantial runway to execute long-term deployments without facing the immediate threat of dilutive equity raises or high-interest toxic debt. Comment below how many shares of BigBear AI you currently hold in your portfolio, and whether you are actively buying this dip or waiting for a clean breakout. When you look at how this business model actually functions under the hood, the entire operation is built around high-consequence decision environments. Unlike mass-market artificial intelligence companies that focus on generic consumer software, text generation, or simple corporate automation, this company engineers complex analytics platforms tailored for environments where operational failure is catastrophic. Founded originally back in 1988 and later publicly listed in late 2021 through a merger with a special-purpose acquisition company, the enterprise has spent decades embedding its data engineering systems into the core infrastructure of the Department of Defense and the wider intelligence community. The business model splits its offerings into distinct functional pillars designed to observe, orient, and dominate complex datasets. This involves taking massive, fragmented, and highly imperfect streams of intelligence data, conflating that information at scale, and using predictive models to give commanders real-time situational awareness during national security operations. This legacy defense business provides a highly stable, recurring baseline of feral capital, but it carries a lower gross margin compared to pure-play software enterprises. The company's overall gross margin currently sits around 25.76%, reflecting a heavy mix of professional service hours and customized engineering work, rather than purely automated software licensing. This is precisely why institutional analysts monitor backlog quality so intensely on professional platforms like Interactive Broker stock trading. The strategic goal for management over the next year is to aggressively shift this mix away from labor-intensive consulting and toward high-margin, repeatable software platforms. The acquisition of companies like Pangiam has given them a massive foothold in digital identity, biometric validation, and advanced travel security workflows, which carry far higher software-as-a-service margins and can be deployed rapidly across global commercial airports, border crossings, and commercial supply chains. The common tension for long-term investors tracking this asset on online investing platforms is balancing the company's clear macroeconomic tailwinds against its choppy financial execution. On one hand, global geopolitical tensions are rising rapidly, forcing the United States military and allied nations to aggressively scale their budgets for algorithmic warfare, cyber-physical vulnerability testing, and autonomous systems tracking. This ensures a steady, expanding pipeline of government requests for proposals that fit directly into the company's core wheelhouse. On the other hand, the corporate financial metrics for the full year of 2025 showed a top-line revenue decline of nearly 19.3%, closing out the year at $127.7 million with a substantial net loss. This historical volatility explains why the stock is currently valued at a microcap market capitalization of around $2.45 billion, trading well below its 52-week high of $9.39, while safely holding above its annual low of $3.01. Looking forward, there are two distinct scenarios that will likely unfold for this stock, and both depend entirely on how reality matches up against the market's current expectations. In the bullish scenario, the recent commercial shipping contract in Panama acts as a successful validation point, prompting rapid adoption from other global shipping hubs and customs agencies throughout Latin America and Europe. If these commercial rollouts begin contributing meaningful, high-margin software revenue over the next 2 quarters, the company's gross margins will expand rapidly, accelerating its path toward net profitability. Combined with the steady monetization of their $281.9 million defense backlog, this operational shift would force institutional analysts using Fidelity brokerage platforms to upwardly revise their forward valuation models, sparking a powerful, fundamental structural re-rating of the stock price well beyond current resistance lines. Conversely, the bearish scenario hinges on execution delays and prolonged sales cycles within both the federal government and commercial logistics sectors. If the international deployment in Panama experiences technical friction or fails to convert into wider regional contracts, the market will quickly write it off as a one-time event rather than a repeatable software business. Furthermore, if the company continues to experience flat or slightly negative organic revenue growth in its core defense segment due to broad contracting delays in Washington, retail traders using the Robinhood app or SoFi investing platforms will likely lose patience. Given the stock's high beta and speculative nature, any perceived stall in their commercial expansion strategy would cause momentum capital to rapidly exit the position, potentially driving the price back down to retest major technical support levels near the $3 mark. When you weigh the absolute reality against the prevailing market narrative, BigBear AI remains a high beta, asymmetric bet on the institutionalization of specialized decision software. The general expectation that it will instantly rocket higher on generic sector hype is fundamentally flawed and repeatedly punished by short-term market corrections like the intraday dip we are seeing today down to $5.08. However, the deeper reality reveals a company with a pristine, debt-free balance sheet, a massive unbooked federal defense backlog, and a highly strategic, real-world operational expansion underway in global commercial logistics. For disciplined investors managing individual brokerage accounts, navigating this asset requires looking past daily social media hype and tracking the hard numbers of gross margin expansion and contract conversion. Success will not be determined off flashy press releases, but by the boring, systematic conversion of a $250 million backlog into realized, repeatable software cash flows. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.